Silver markets experienced a notable intraday price reversal on Monday, the 9th of March, 2026, moving from a session low of $83.35 per troy ounce, recorded at 10:17 in the morning Eastern Standard Time, to $86.31 per troy ounce by 11:53 in the evening. That movement represented a recovery of $2.96 from the session low, completing what the source report describes as a V-shaped intraday price reversal within approximately 6 hours of the morning low being established. The session opened with silver at $84, the level at which it closed on Friday. During the morning session, the spot price declined through that level, reaching the day's low of $83.35 at 10:17 Eastern Standard Time. The subsequent recovery carried the price back above the Friday closing level and extended to $86.31 by late evening. Bloomberg published an alert at 7:42 in the morning stating that the Middle East conflict was de-escalating and that precious metals were in retreat. At 8:19, CNBC featured an analyst commenting on silver market conditions. At 9:03, trading activity on the COMEX intensified, with significant contract volume entering the market. On the energy front, Brent crude oil spiked to $119.17 per barrel at 11:41 in the morning, the highest level recorded since June of 2022, when gasoline reached $7.83 per gallon in California. The International Monetary Fund published an emergency economic outlook at 11:27 in the morning, warning that global stagflation was mathematically inevitable due to the simultaneous collapse of supply chains and the explosion of energy costs. The CME Group reported at 12:03 that physical silver demand in the Asian trading session had increased by 47% compared to the previous Monday's volume. On the COMEX futures market structure, the most recent data published on March 7, 2026, shows open interest in silver futures contracts at 642 million ounces. Against that figure, COMEX registered vault inventory, representing physical silver available for delivery, stands at 73 million ounces, producing a ratio of approximately 8.7 paper claims for every 1 ounce of registered physical silver. With the day's price action, energy market developments, IMF warning, and physical market data now established, our coverage continues with a detailed examination of the COMEX market mechanics, the specific timeline of Monday's trading session, and the production cost framework that underpins current market conditions. To fully understand the significance of Monday's intraday price movement in silver, it is necessary to examine the specific mechanics of how the COMEX silver futures market operates, the precise timeline of trading activity that unfolded during the session, and the production cost data that forms the physical backdrop against which paper market pricing is occurring. The COMEX silver futures market operates on a structure in which sellers are not required to possess the physical metal represented by the contracts they sell. Provided a seller posts sufficient margin collateral, they are permitted to sell contracts representing silver they do not own, do not control, and cannot deliver. This type of position is referred to as a naked short. A standard silver futures contract on the COMEX represents 5,000 ounces of silver. According to the most recent COMEX data published on March 7, 2026, open interest in silver futures contracts stands at 642 million ounces. The COMEX registered vault inventory, representing physical silver actually available for delivery, currently holds 73 million ounces. The resulting ratio is 8.7 paper claims for every 1 ounce of registered physical silver in the exchange's vaults. The exchange itself has publicly stated that less than 1% of contracts result in physical metal delivery, with the remainder settled in cash. The source report describes the practice of stop hunting as a trading tactic, in which large institutional players, with access to high-frequency trading algorithms and advanced order flow data, use their visibility into the location of retail stop-loss orders on the COMEX order book to engineer artificial price movements. Retail investors who purchase silver through brokerage accounts or exchange-traded funds typically set automatic sell orders at specific price levels to limit potential losses. These orders are reported to be visible to institutional traders with access to order flow data. The tactic involves selling large volumes of contracts to drive the price to levels where those automatic sell orders are triggered, generating additional downward price pressure from the automated retail selling, and then purchasing contracts or physical metal at the resulting suppressed prices. The specific timeline of Monday's trading session, as documented in the source report, unfolded as follows. At 7:42 in the morning Eastern Standard Time, Bloomberg published an alert stating that the Middle East conflict was de-escalating and that precious metals were in retreat. At 8:19, CNBC featured an analyst commenting on silver market conditions. At 9:03, institutional algorithms began selling large blocks of silver contracts on the COMEX. By 10:17, the spot price had declined to $83.35 per troy ounce, the session low. At 11:27, the International Monetary Fund published an emergency economic outlook, warning that global stagflation was mathematically inevitable due to the simultaneous collapse of supply chains and the explosion of energy costs. At 11:41, Brent crude oil spiked to $119.17 per barrel. At 12:03, the CME Group reported that physical silver demand in the Asian trading session had increased by 47% compared to the previous Monday's volume. At 12:19, the first wave of institutional buy orders began entering the COMEX. By 1:37 in the afternoon, the price had recovered to $84.50. By 3:09, the price had broken back above $85. By 6:42 in the evening, the price had reached $86.31, where it stood at the time of the report being recorded at 11:53 in the evening. The source report also references a prior trading episode on March 22, 2025, in which silver declined from $91 to $73 in a single trading session. In that prior episode, the report states that the price subsequently recovered to $108 in what it describes as the most violent short squeeze in modern COMEX history, with the full sequence from the low to the high occurring over a period of weeks following the session low. Turning to the production cost framework, the source report cites data from the Silver Institute's most recent World Silver Survey. According to that data, the all-in sustaining cost of primary silver production, encompassing extraction, refining, transportation, environmental compliance, and corporate overhead, currently averages $73.42 per ounce across the global mining industry. That figure was calculated in a $90 per barrel oil environment. The report identifies an incremental relationship between oil prices and silver production costs, stating that every dollar increase in oil prices above the $90 baseline adds approximately $1.17 to the all-in sustaining cost of silver production. The energy inputs identified as directly tied to crude oil prices include diesel fuel for haul trucks, electricity for ore processing, natural gas for smelting, jet fuel, and heating oil for remote mining operations in Canada and Alaska. Applying that relationship to the current oil price of $119 per barrel, which represents $29 above the $90 baseline used in the cost calculation, the report calculates the current true all-in sustaining cost of silver production as $73.42 plus 29 multiplied by $1.17, which equals $87.35 per ounce. The source report notes that the current COMEX spot price of $86.31 is below that calculated production cost figure by $1.04 per ounce. The report additionally references 3 historical episodes in which oil prices crossed the $100 threshold and documents the subsequent silver price movements in each case. In February of 2008, oil spiked to $115 per barrel due to Middle East supply concerns, and within 4 months, silver had rallied from $15.83 to $21.44, a gain of 35%. In April of 2011, oil spiked to $113 due to the Libyan civil war and Arab Spring disruptions, and within 3 weeks, silver rallied from $37.19 to $49.82, a gain of 34%. In June of 2022, oil spiked to $123 due to the Russian invasion of Ukraine and European energy sanctions, and within 8 weeks, silver rallied from $21.11 to $26.94, a gain of 27%. Turning now to retail physical silver market conditions. The source report documents current pricing at 4 major online bullion dealers in North America as of the evening of Monday, the 9th of March, 2026. At At.a.m, the current price for a 1-ounce Canadian silver maple leaf coin is $94.73. At J.M. Bullion, the same coin is priced at $93.89. At SD Bullion, the price is $93.42. At Monument Metals, the price is $92.97. Against the COMEX spot price of $86.31 at the time of the report, the average retail premium across those 4 dealers is $7.69 per ounce, representing an 8.9% premium above the paper spot price. The source report places that current premium figure in historical context by noting the following data points. 3 months prior to the report, the average retail premium stood at 3.2%. 6 months prior, it stood at 2.4%. The report identifies the March 2020 episode as a comparable historical reference point for premium expansion, noting that during that period the COMEX spot price fell to $11.73 per ounce, while retail dealers were selling Silver Eagles at $24 per ounce. The report also references February of 2021, during which premiums reached $14 over spot, as refiners were unable to produce coins at sufficient volume to meet demand. On Chinese physical silver import activity, the source report cites data from the Shanghai Gold Exchange monthly import records, verified against Chinese customs records. According to that data, China has been a net buyer of physical silver for 16 consecutive months, as of the time of the report. In January of 2026 alone, Chinese institutions imported 4,217 metric tons of physical silver. The report states that figure represents a 41% increase compared to January of 2025. On BRICS trade settlement developments, the source report documents the following sequence of events. On February 14, 2026, the BRICS alliance officially announced the launch of a gold-backed trade settlement system, enabling member nations to conduct international commerce without using United States dollars. The system is described as a digital currency, fully backed by physical gold, held in independently audited vaults. Brazil, Russia, India, China, and South Africa are identified as founding members, collectively representing 42% of the global population and 31% of global gross domestic product. On February 21st, Saudi Arabia conducted its first oil transaction with China using the BRICS settlement system instead of the petrodollar, ending a 51-year agreement requiring all Saudi oil sales to be denominated in United States dollars. On March 2nd, the United Arab Emirates announced it would begin accepting BRICS currency for natural gas exports. On March 6th, Indonesia confirmed it was joining the alliance and would transition 30% of its commodity exports to the new system by the end of the second quarter of 2026. On United States Treasury bond holdings by foreign nations, the source report cites the Treasury International Capital Report published on March 4, 2026. According to that report, foreign holders reduced their Treasury bond positions by $217 billion in the month of January alone. The report identifies that figure as the largest single-month reduction in foreign Treasury holdings since the data series began in 1978. On the repo market, the source report documents that on March 7, 2026, the overnight repo rate spiked to 6.13%, 1.38 percentage points above the Federal Reserve's current target rate of 4.75%. The report identifies that spread as the largest recorded since September of 2019, when the repo market froze and required the Federal Reserve to inject $85 billion in emergency liquidity to prevent a systemic collapse. The report notes that as of the time of recording, the Federal Reserve had not publicly acknowledged the current rate spike or announced any emergency intervention measures. On the historical timeline of silver price suppression episodes referenced in the source report, the following sequence is documented. In 1980, silver reached $50 per ounce, and the COMEX subsequently changed margin requirements overnight, forcing liquidation. In 2008, silver declined from $21 to $8.88 over 6 months. In 2011, silver reached $49 per ounce, and the CME raised margin requirements 5 times over 9 days, triggering a significant sell-off. In March of 2020, silver declined to $11.73. In March of 2025, silver declined from $91 to $73 in a single trading session, before recovering to $108. The source report notes that the duration between the initiation of each suppression episode and the subsequent price recovery has shortened across these consecutive events, from years in earlier instances to weeks in 2025, and to approximately 6 hours in the Monday, March 9, 2026 session. On the question of COMEX delivery obligations, the source report states that if 15% of current contract holders were to demand physical delivery rather than rolling contracts forward or accepting cash settlement, the exchange's registered vault inventory of 73 million ounces would be insufficient to fulfill those delivery requests against the 642 million ounces of open interest. The legal mechanism for declaring an inability to fulfill delivery obligations is identified in the report as force majeure. The report further references the Nixon administration's closure of the gold window on August 9, 1971, which ended the Bretton Woods system. In the 12 months following that decision, the price of silver increased from $1.39 per ounce to $2.56 per ounce, representing an 84% gain. As Monday's trading session concludes and Asian markets open for the new session, the full scope of reported developments across silver market price action, COMEX market structure, energy prices, physical dealer premiums, production cost data, BRICS trade settlement activity, repo market conditions, and Chinese import figures can now be consolidated into a single comprehensive summary. On silver price action, the spot price opened Monday's session at $84 per troy ounce before declining to a session low of $83.35 at 10:17 in the morning Eastern Standard Time. A recovery subsequently carried the price to $86.31 by 11:53 in the evening, a net gain of $2.31 from the Friday close, and a recovery of $2.96 from the session low. The full round trip from the morning decline to the evening recovery occurred within approximately 6 hours. The session's trading activity unfolded against the following sequence of external developments. Bloomberg published a de-escalation alert regarding the Middle East conflict at 7:42 in the morning. At 9:03, significant contract volume entered the COMEX. At 10:17, the session low of $83.35 was recorded. At 11:27, the International Monetary Fund published an emergency economic outlook warning that global stagflation was mathematically inevitable due to simultaneous supply chain collapse and energy cost explosion. At 11:41, Brent crude oil spiked to $119.17 per barrel, the highest level recorded since June of 2022. At 12:03, the CME Group reported a 47% increase in physical silver demand from the Asian trading session compared to the prior Monday's volume. Institutional buy orders began entering the market at 12:19, and the price recovered progressively through the afternoon and evening hours to reach $86.31 by late evening. On COMEX market structure, open interest in silver futures contracts stands at 642 million ounces as of the data published March 7, 2026. Registered vault inventory available for physical delivery stands at 73 million ounces. The resulting leverage ratio is 8.7 paper claims per registered physical ounce. The exchange has publicly stated that less than 1% of contracts result in physical metal delivery. On production costs, the Silver Institute's most recent World Silver Survey places the global industry average all-in sustaining cost at $73.42 per ounce, calculated in a $90 per barrel oil environment. Each dollar increase in oil above $90 adds $1.17 to per ounce production costs. At the current oil price of $119 per barrel, $29 above the baseline, the calculated current all-in sustaining cost is $87.35 per ounce, which exceeds the current COMEX spot price of $86.31 by $1.04. On retail physical silver premiums, the 4 largest North American online bullion dealers are currently pricing 1-ounce Canadian silver maple leaf coins at the following levels: At.a.m at $94.73, J.M Bullion at $93.89, SD Bullion at $93.42, and Monument Metals at $92.97. The average premium across these 4 dealers is $7.69, or 8.9% above the COMEX spot price. That compares to an average premium of 3.2% 3 months prior and 2.4% 6 months prior. On Chinese physical silver imports, the Shanghai Gold Exchange monthly import data, verified against Chinese customs records, shows net physical silver purchases for 16 consecutive months. January 2026 imports totaled 4,217 metric tons, a 41% increase compared to January 2025. On BRICS trade settlement, the gold-backed settlement system was officially launched on February 14, 2026, involving founding members representing 42% of global population and 31% of global gross domestic product. Saudi Arabia conducted its first oil transaction with China under the new system on February 21st, ending a 51-year petrodollar arrangement. The United Arab Emirates announced acceptance of BRICS currency for natural gas exports on March 2nd. Indonesia confirmed its accession, and a 30% commodity export transition by end of the second quarter on March 6th. Foreign holders reduced United States Treasury bond positions by $217 billion in January 2026, the largest single-month reduction since the data series began in 1978, according to the Treasury International Capital Report published March 4th. On the repo market, the overnight repo rate stood at 6.13% on March 7th, 1.38 percentage points above the Federal Reserve's 4.75% target rate, representing the largest spread since September of 2019. The Federal Reserve has not publicly acknowledged the current rate spike or announced emergency intervention measures as of the time of the report. Historical silver suppression and recovery episodes documented in the source report span from 1980 through March 2025, with the most recent prior episode in March 2025 involving a decline from $91 to $73, followed by a recovery to $108. The 3 historical oil spike episodes referenced show subsequent silver gains of 35% within 4 months in 2008, 34% within 3 weeks in 2011, and 27% within 8 weeks in 2022. The current episode marks day 12 of the latest oil price spike, with Brent crude at $119.17. Key data sources identified in the report for independent verification include the COMEX registered vault inventory reports updated daily and publicly available, the Silver Institute World Silver Survey, the CME Group volume reports, the Shanghai Gold Exchange monthly import data, Chinese customs records, the Treasury International Capital Report published March 4, 2026, and the Bank for International Settlements cross-border payment data. Asian markets including Shanghai, Hong Kong, Singapore, and Tokyo opened approximately 47 minutes before the time of the report's recording at 12:07 in the morning Eastern Standard Time on Tuesday, March 10, 2026. This has been a comprehensive market briefing covering Monday's silver intraday price action, COMEX market structure and leverage ratios, production cost data, retail dealer premium levels, Chinese physical silver import figures, BRICS trade settlement developments, United States Treasury bond holding reductions, and repo market conditions as of Monday, the 9th of March, 2026. All figures and developments reported are drawn exclusively from the original source material. Individuals are encouraged to verify all data points through the publicly available primary sources identified in this broadcast, and to consult qualified financial professionals before making any decisions related to commodity markets or investment portfolios. We will continue to monitor all developments as the Tuesday trading session approaches. Thank you for watching.